Is up, YouTube? This is the Working Investor. You guys must be so dizzy looking at my system of trading. You're like, one day he does this, one day he does that. Is he this guy? Is the Working Investor an options guy? Is he a high yield dividend ETF guy? Is he a little bit of both? Is it possible to be both? Yes, it is. And yes, my strategy has been evolving. You know, if you look at the weather channel, you'll see different patterns of weather. So that's where my strategy has been moving around. I digress. So basically, as you could see, that my investing in the high yield dividend ETF space went from a solid $75,000 down to like just under $45,000. I did not lose $30,000. I did not have a diet of $30,000 in the high yield dividend ETF. They didn't go that bad. The sandwiches didn't eat themselves up and implode on themselves. I basically reduced my experiment in the sandwiches. First, I took a couple of them off, and then I decided to put them all back on. But instead of big sandwiches, I'm doing little bite-sized sandwiches because I'm running these experiments, and that shouldn't be the core of my position with these experiments. So instead of having $45,000, $15,000 per sandwich, I knocked it down to $15,000 of experimental money to experiment with, and it's $5,000 per sandwich. And these are the little bite-sized nuggets that I'm doing. That's why you see the dip of 30 grand in the portfolio. And also, I'm enjoying trading, doing some trades on my own, and I'm keeping some dry powder out because there are some new funds coming out from Roundhill, like RDTE, and it looks like they got some single stock ETFs, but mostly RDTE is what I'm looking into. So I want to have some money to put there and see how things work. So what I call these ETFs, I call them like my base, because when I'm an option trader, you know, sometimes I make a little more, sometimes less. Here, I keep myself accountable. I want to have like a baseline income. Of course, the income from the high yield dividend ETFs, they can fluctuate from month to month. But the most important reason why I do it is that sometimes I don't have enough time and enough energy to do all the trades that I like to do and the styles I like to do. So here I could hire these fund managers, aka purchase these shares that these fund managers are running with different various strategies. And I could use various fund managers, and they're doing, even if they're doing similar strategies, they're different people. So you're getting like a whole team of fund managers working for you. You do pay them a little expense ratio. So let's go into the portfolio and see what's going on. So first we'll go down to the high yield dividend ETF. So I got my AMZ Army. I got 5,000 in AMZ that I put in, 5,000 in Phoebe. I have 5,000 in NVIDIA, the entity of NVIDIA, but the entity of NVIDIA is hedged. Well, not of course the prospectus of DIPS says do not hedge, do not use these inverse as hedges, but I'm using them as hedges. So basically I'm doing 5,000 in NVIDIA, which is divided by 3, it's a 60-40 split. And I'm actually doing all the sandwiches 60-40, a little bit skewed on the bullish side of every single sandwich. 60% bullish, 40% bearish. So basically with NVIDIA and dips, so I have 3,000 NVIDIA and 2,000 dips. So why I do these sandwiches is because both sides are on the same underlying of NVIDIA, and NVIDIA has a lot of implied volatility, specifically this week because they have earnings, but in general they have a lot of implied volatility. You get to capture lots of premium. The funds capture lots of premium, sometimes there's call skew, and then sometimes there's put skew. Actually in general, I was listening to Tom Sosnoff from Tasty Live, and they did a lot of research of call skew and put skew when there's more fear in the market and people are panicking to buy puts, where, you know, demand and supply, there's more of a demand for puts. So therefore the price, if you're an option seller of puts, is increased. So it's more, you get richer premium if you're a seller, and you pay more if you're a buyer of the put. And that's what they call the put skew. Sometimes it's just slightly skewed. It doesn't make such a huge difference. So that's why I like to use these calls and synthetic cover calls, which of NVIDIA, which is NVIDIA, which the Yieldmax does, synthetic cover calls in NVIDIA. And I like to also purchase at the same time synthetic covered puts in NVIDIA, which is they call dips. So together, when you do a short call, a short put, it's called a synthetic covered strangle. So that I would like to look at it like a synthetic covered strangle. Of course, sometimes there's call skew, sometimes there's put skew. Like I said, most of the time there's put skew. But Tom Sosnoff did mention, they did a lot of research, like sometimes meme stocks like GameStop or whatnot, they would have like call skew. Sometimes you have these rare unicorn circumstances where there's call skew. But also sometimes doesn't mean that the premium is always richer per share on one side or the other, or percent. I would say percent, because sometimes one share could be higher or lower. I mean that, in general, it should be more rich on the put side, but sometimes it really depends on what the fund manager chooses. Because if a fund manager chooses a further out of the money strike price on the put and a closer out of the money call, then the call will be richer. So it's really, really hard to say. It's really hard to say. But here I get to enjoy, whatever NVIDIA does, it goes up or it goes down or whatever, or tumble sauces. The idea of the hedge is it kind of keeps you could sleep at night. But of course, it's not foolproof, because obviously if it drops all the way, then even your short, your dips won't cover you, because if it blows past the strike prices, then you're kind of done in a way. So it's not foolproof. And like the prospectus itself says, do not use it as a hedge. But of course, I use it as a hedge, right? Not financial advice whatsoever. So I do the same thing with the Tesla crash. Got 5,000 in the Tesla entity where I'm hedging, I'm bullish and bearish. I'm both bullish and bearish, aka more neutral, but slightly bullish on Tesla, slightly, ever so slightly. And then that's how I'm playing it now. And I got my Coney Fiat, again, 60% in Coney, 40% of Fiat, 5,000 in the entity. So if you notice, 5,000 AMSI, 5,000 Phoebe, 5,000 in entity of NVIDIA, which includes the sandwich, 5,000 entity of Tesla, which includes a sandwich, 5,000 entity of Coney, which I'm not a big fan of Coney of Coinbase, but I'm more of a fan of the Bitcoin exposure. So kind of have it, sort of has the exposure, but of course, Coney is a company in itself, it needs to make revenue. So kind of in this Coney fiat space. And then I have the XDTE, QDTE, which is my core, 10,000 in each allocation right now. And then we'll talk about TNA is a Russell 2000 triple leverage ETF, where I'm doing at the money call to bring in some premium. And then I got FEPI. So I'm using, I like FEPI. I want to build up 100 shares of FEPI just as a short-term goal, which is about a little over $5,000. But I don't want to spend money from my paycheck. I want to use the proceeds of spillover dividends and wins from options or maybe cash back. So I want to build up this position completely free. I like FEPI because it historically has been NAV neutral, it kept its NAV stable historically for the most part. Doesn't mean, past performance is not indicative of future returns. And also it historically has been pretty stable with its 25% return. And it works on the NASDAQ, but specifically I think around 15 heavy underlyings of the NASDAQ. It does not do zero date to expiration moves. So I got this FEPI spillover, and then BITO, just forget it's there, because I actually have an in the money covered call that I'm doing on BITO. I'll probably have my shares called away. The point of putting this on was just to grab some premium. But if it goes down, then I'll just hold the shares and receive a distribution. I do have a shout out to one of my subscribers. I follow him, and he has pretty good videos. He does a lot of option videos. I think it's the retirement in the Philippines. I butchered his name. I'll have to look up his name, but retirement dividends in the Philippines. Very smart guy. He knows a lot about options. I learn a lot from his channel. He has good in-depth videos about BITO. So yeah, highly recommend. So yeah, so that's what I'm doing right now. I know that there's like the saying from the Oracle, like, why pay somebody to wash your car? If, why wash your car yourself if you could pay someone to wash your car? So that's why I have these high yield dividend ETFs to give me some baseline car wash. To give me, I pay these expense ratios for them to do the trades for me, so it could be more passive. But just like in real estate, you have a property manager. You can't just go to sleep. You need to manage the managers. So the same thing, I believe, with investing. You need to manage the managers. That's another reason why I like FEPI, not because of the extraordinary return, but not only for the reasons that I mentioned, but also because FEPI is through RecShare, so it's a different company, I believe, different managers. QDTE, XDTE are through Roundhill, so I have them. They've been, so far, it seems like they're doing a pretty good job there. Then I have of course tons of exposure to Yieldmax. So I'm not going to put all my apples in one basket. I want to hire a group of managers and explore a group of managers, aka through different funds, and have a group of managers work these options. Because if one manager is not doing such a good job, why should you put, my theory is, why should I put all my apples in one basket and have one manager mess up the trades, for one underlying. So that's why I like to have a variety of managers. Because these funds are actively managed, hence actively managed, it really does matter what the manager does. It's not like those Vanguard, ETFs. I've seen Vanguard ETFs that are mutual funds from Vanguard that are like 0.02 expense ratio, which is a joke. It's laughable. But the thing is, they're just doing allocation rebalancing and just putting a percentage. You could just go on M1 Finance and put in like 10,000 stocks and make yourself like these little percent what do you call it, like these little pieces, and you could literally make your own type of fund for yourself and rebalance it and these slices, and you could 10% this, 20% this, and in each of the 20% you could break it down further. So it's so easy. You could literally make your own type of your personal mutual fund, if you like, in M1 Finance. And I'm not saying they're the best, but they have some cool stuff. But but these are things that are being traded, very specific. Some of them are 0 day to expiration. That means every single day a trade is being put on, or every month, every couple of weeks. Even if they put on a trade once a month, they have to watch the market. They have to see what's going on. You want to have somebody who's really active and keeping an eye on your money. So that's why I like to go a little bit, diversify out through RecShares, Roundhill, Yieldmax, maybe others. We'll see. So, and then of course, if you could hire someone to wash your car, then why do you have to wash it yourself? Well, there are some strategies that I do that they don't offer in these funds, at least not yet. I haven't seen funds that do. Maybe there are funds out there that do properly do covered strangles. I wonder, if someone knows a fund that does that, let me know and let's see how they do. But really, really cool about the 0 day to expiration options. But I haven't seen funds that do, triple leverage products. I haven't seen funds that do other kinds of stuff. So I have seen funds that do BITO. That is true. There are funds that literally, do options on BITO, synthetic cover calls on BITO. I have seen that. But that's why I do a little bit of both. And if you if the person washing your car is doing like a shoddy job at it, then maybe they're just good at basic stuff. And if you need like a deep cleaning, you may have to get down and dirty and do some of the stuff yourself if you want the job done correctly. But of course, if you can have someone else do it, then you could, that would be great. But if sometimes yes, and sometimes no. Maybe for simple stuff, you can hire people, and for more complex stuff, or, if you're going to get a much higher return potentially, then why not do things yourself? Or if you have more control over the return, why not do things yourself? If you can, if you're fortunate enough. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful evening, wonderful weekend, or week. Weekend's over. Wonderful week. Hopefully one day you guys could have financial freedom where the week becomes your weekend. That would be awesome. All right, take care.